Is it possible to retire with just a single dividend fund, like Vanguard's High Dividend ETF, ticker symbol VYM? A better question would be, is this a smart decision? And an even better question is, how resilient has VYM actually been since its inception? Let's find out by stressing the crap out of VYM to see exactly what kind of retirement you could have had with this dividend fund. The general concept of a dividend strategy is to invest in dividend stocks or funds, and over time, build up a large enough stream of dividend income to supplement or fully fund your retirement income. At least that is the plan most dividend-focused investors follow. But life doesn't give a crap about your plans, and it likes to throw you a curveball every once in a while, typically when you least expect it. When you're still actively working and building your dividend portfolio, you may have several levers to pull on to deal with any such life problems. However, after you retire, you may not have the luxury to adjust your income should such a need arise. With a dividend portfolio, you really only have two options to increase your income in retirement. You can either reallocate your assets to higher yielding securities, or you can sell shares of your existing securities to raise the necessary capital. VYM has been around since late 2006, and it has grown at an average rate of 8.61% per year. That growth wasn't very consistent, nor was the dividend income this fund paid over the last 18 years. At the end of 2006, VYM paid a dividend yield of roughly 2.7%. It certainly wasn't a high dividend yield, as the fund's name would suggest, but it wasn't terribly low either. If a 2.7% yield was sufficiently high enough to give you enough dividend income in retirement, with the capital you had available to allocate to this fund, investing in VYM could have been seen as a smart option. The fund would offer you exposure to 500 stable, large-cap value stocks that would not only offer you consistent dividend income, but also had the potential for capital appreciation. Suppose that you retired in December of 2006, and you had $1 million to fund your dividend income, and $26,000 per year was sufficient to supplement your Social Security and any other income, and you invested all of this capital into VYM. How would your retirement unfold? If you timed your investment right, you could have caught the December 2006 dividend payment and enjoyed a nice $3,449 kickoff bonus right around Christmas. In 2007, VYM would have paid you $26,749 in dividends, broken down into 4 quarterly payments in March, June, September, and December. The market value of your portfolio would remain above $1 million for the entirety of 2007. Sure, you'd see a minor dip at the tail end of 2007, in what was ultimately the beginning of the financial crisis, but you wouldn't have known this at the time. And after all, you're already retired. VYM is giving you enough dividend income, so maybe you're not overly concerned with any market volatility. In 2008, your shares of VYM would have paid you $28,444 in dividend income, roughly 6.3% more than the prior year, which is a very nice increase. Meanwhile, you'd watch the market value of your shares decline to roughly $662,000, which is a roughly 34% loss on your starting capital. This is definitely not an ideal position to be in, but VYM paid you more dividend income, so perhaps you aren't too worried about this prolonged financial crisis. In 2009, VYM would have paid you only $23,023 in dividend income, 19% less than the prior year, and maybe you start to become worried at this point. Also, in 2009, the market value of your portfolio would bottom out at around $497,000, or a more than 50% decline from your starting capital. By the end of 2009, you'd recover some of this paper loss, provided you held your position, and your portfolio would finish the year with a value of $749,000. Then 2010 rolls around, and VYM pays you even less dividend income than the year before. This time your income would have been $21,506, or 6.5% less than the prior year. The market value of your shares would improve to $832,000 by the end of the year, so you're still not back to net zero. 4 years in, your dividend income is declining, and well below what you originally anticipated it would be, and you've lost $170,000 of your original capital. This is turning out to be a retirement nightmare you never imagined would happen to you. Well, today we know exactly what happened later. Your dividend income would grow each year starting in 2011 through 2024. In 2011 and 2012, you'd see the largest increases in dividend income, with both years clocking in above 20%. From then on, you'd average about 6.7% dividend growth per year, not very consistent, but always positive. By 2024, you'd be receiving over $68,000 in dividend income. almost 3 times the original $26,000 VYM would have paid you in 2007. The market value of your shares would consistently improve as well. There were a few periods of stagnation and a few bumps along the way. But by 2013, you'd be back above $1 million and never again dip below it. By 2021, you'd cross the $2 million threshold, and by the end of 2024, you'd be more than halfway from $2 to $3 million. Overall, not a bad finish, but definitely not an easy journey. 2 years of decline and inconsistency in income is a very long period to weather. But let's stress this retirement scenario a little bit more to see if VYM would hold up. Let's say that you absolutely needed that $26,000 in annual income from this fund, and you also needed to adjust it for inflation each year. The average rate of inflation between 2006 and 2024 was 2.39%. I'm just going to assume here that this was a consistent rate of inflation each year. I'm going to leave our starting balance as $1 million. I will also set the annual withdrawal rate to 2.6%, which would give us the $26,000 in annual income in the first year. Inflation will be 2.39% per year, as I mentioned earlier, and we will start this test in December of 2006. In this test, if the dividend income from VYM is insufficient to meet our required withdrawal rate, I will sell the necessary amount of shares to bridge the gap. However, if VYM gives us too much dividend income, we will use the excess capital to purchase more shares of VYM, in turn increasing future dividend income. And we can see that our VYM portfolio performs very well in this test. The market value again dips during the financial crisis, bottoming out at $497,000, roughly the same amount as in the pure dividend income test we just went over. But by the end of 2024, our market value is very close to $3 million, $2.89 million to be a little bit more exact. We can see that the number of shares of VYM held does dip a little bit, mainly in the few years following the financial crisis, as it took a little while for our dividend income to recover and catch up with our inflation-adjusted rate of withdrawals. By the end of 2024, we would actually have a little more than 2,000 additional shares of VYM purchased in our portfolio. And the last time we were forced to sell any shares to fund our withdrawals was March of 2013. In total, our portfolio would pay us $817,000 in dividends over this 18-year period. That's about $20,000 more than the pure dividend example we covered first. Between late 2021 and throughout the remainder of the test, several dividend payments were more than double the quarterly withdrawals, a rather healthy position to find yourself in. Around mid-2015 is when the cumulative dividends paid started to exceed the cumulative withdrawals taken from the portfolio. And by the end of 2024, the cumulative dividend income was roughly $230,000 higher than the cumulative withdrawals. So even though we would still have to endure seeing the market value of our portfolio decline over 50%, I think VYM performed very well in the stress test. Let's throw a life curveball into this scenario to stress VYM even more. Let's say you retired in December of 2006, and a few days later you were diagnosed with a medical condition, and all of a sudden you find yourself in a situation where you will require more income. Instead of the original $26,000 you thought you needed, let's assume that you will need $40,000 each year, and you will need to increase this amount at the rate of inflation going forward. So let's change the withdrawal rate in our test from 2.6% to 4%. From the market value chart, we can see that our VYM portfolio would have held up, but let's take a closer look at the specific outcome. The market value of our portfolio would dip to about $479,000 during the financial crisis. That's a 52% decline from our starting value. But by the end of 2024, we would still end up with a valuation of about $2 million. In the number of shares held chart, we can see that we would need to sell more than 4,000 of our original 19,712 shares. The bulk of this selling took place around the bottom of the financial crisis and in the few years that followed. Our portfolio would have paid about $654,000 in dividend income, roughly $170,000 less than in the prior example. We can see that only a few of the more recent quarterly dividend payments fully covered our quarterly withdrawals. The excess capital required to fund withdrawals is trending in the right direction, but does become more volatile in more recent years. In total, the dividend income at the end of 2024 was about $250,000 short of the cumulative withdrawals. Overall, our VYM portfolio held up nicely in the stress test, but if we find ourselves in another market crash, the following decade might not look as great, as we now have 4,000 less shares, and the dividend income is still not consistently covering our rate of withdrawals. Let's push VYM even more. Let's assume that we would need $50,000 in annual income rather than $40,000. So let's change the withdrawal rate to 5%. Based on the market value, VYM still looks appealing. By the end of 2024, we would have a valuation of roughly $1.365 million. The bottom of the financial crisis would see our valuation dip to $466,000. If we look at the number of shares held, things start to look a bit more grim, as the chart is steadily moving lower. By the end of 2024, we would have sold more than 9,000 of the original 19,712 shares. And there was not a single quarter where we would have been able to buy more shares of VYM to stop the bleeding. The total amount of dividend income paid now stands at only $537,000. And we can see that the excess capital required each quarter has remained very consistent through this 18-year window of time. Arguably, it has even gotten a little worse more recently, occasionally exceeding $10,000 per quarter. The total dividend income generated by our portfolio is less than half of the total withdrawals. So while VYM would have held up in the stress test, we can clearly see that this is not sustainable forever, and this portfolio would likely begin to decline in the next few years. If we stress this portfolio even further to a 6% rate of withdrawal, it still holds up, but it would most certainly fail in the next few years. And at a 7% rate of withdrawal, our portfolio would dwindle down to a valuation of just $88,000 by the end of 2024, implying that this is just about as much as VYM could have sustained for this 18-year period of time. I believe VYM has been an excellent fund to own since 2006, and that despite some of its shortcomings, it held up very well through the financial crisis. If you weren't investing in the market during the financial crisis, you may not realize just how bad things were. VYM declined by more than 60% from its prior all-time high to its bottom, and this was roughly a 15 to 16-month period of consistent pain for an investor. However, since the bottom of the financial crisis, VYM has grown by over 500%, and it's largely due to this growth and capital appreciation that it was able to handle a relatively modest amount of stress in terms of excess withdrawals above the dividend income paid. Before I wrap up, let me show you just how impactful a little luck and timing in the market can have. Let's stick with this 7% rate of withdrawal and the rest of the test assumptions, but I will change the start date from December 2006 to March 2009, the bottom of the financial crisis. Keep in mind that it's easy to do this since we already know what happened, but choosing to retire after watching the market decline for 15 months would not have been an easy decision to make at the time. But look at the outcome. The value of our portfolio would have never been less than the original $1 million. By the end of 2024, our valuation is over $5 million. While we still would have had to sell some shares along the way, now, instead of starting with 19,712 shares, we would have started with over 40,000 shares, and finished with just a few shares less. Our VYM portfolio would have paid us over $1.4 million in dividends. Since 2016, the dividend income would have fully covered the 7% inflation-adjusted rate of withdrawals, barring one exception in March of 2020. By September of 2022, the cumulative dividend stream would surpass the cumulative withdrawals. And once this happens, it's game over, until of course the next market crash comes along. If you enjoyed this analysis and you would like to run your own stress test on VYM, you can grab a free copy of this spreadsheet. I shared it in my newsletter. There's a link to the original article in the description below. At the bottom of the article, there's a free link to download this same exact spreadsheet. No sign up required this time, but if you would like to see similar analysis in the future, please consider signing up for the newsletter. Also, please help me out by giving this video a like and subscribing to my channel. Thank you for watching and see you next time.